Hi everyone, welcome back to Corporate Decoder, the place where we try to make sense of the fancy financial papers filed by big companies. And let me tell you, Sempra has some interesting moves to talk about today. We're diving into their latest Form 8K report, and it's all about new debt to fund some pretty big plans. So what exactly is Sempra telling us here? Well, on August 29th, 2025, they basically announced they've successfully sold a boatload of new debt, a whopping $800 million worth. This isn't just any debt though, it's called junior subordinated notes, and they're paying a pretty hefty interest rate of 6.375% fixed until 2056. Now that sounds like a lot, but let's break down what this means for Sempra and for us as observers of the corporate world. First off, you'll see their common stock ticker SRE and their junior notes ticker Shriya, both listed on the New York Stock Exchange. This is how you'd buy or sell pieces of Sempra. It's showing us they're a publicly traded company with ownership divided into shares, and these notes, which are basically loans from investors to the company. This initial part of the filing is like the cover page. It tells us this is an 8K filing, which signifies a report of significant events that happen between the regular quarterly or annual reports companies usually file. Think of it as a press release, but with more formal legal language and disclosures. It's like a company shouting out something important. Suddenly happened you all need to know. Now let's get to the real juicy stuff, the purpose of this filing. Sempra just finished selling $800 million of these junior subordinated notes. You might ask, why junior, why subordinated? Well, it's debts. Subordinated means the same thing, basically other debts get paid first. This often means they have to offer a higher interest rate to attract buyers because of that extra risk. The interest rate is 6.375%, which is fixed for a period, and then it can be reset. This is a pretty long-term commitment, potentially lasting until 25 debts. Subordinated means the same thing, basically other debts get paid first. This often means they have to offer a higher interest rate to attract buyers because of that extra risk. The interest rate is 6.375%, which is fixed for a period, and then it can be reset. This is a pretty long-term commitment, potentially lasting until 2056. They raised about $792 million after paying the banks that helped them sell these notes. So with those minor expenses, it's a massive influx of cash. What are they doing with it? This is key. They plan to use this money to help pay off another type of stock, their 4.875% fixed rate reset cumulative redeemable perpetual PRED stock series C. They're essentially refinancing, meaning they're paying off an older debt or financial instrument with a new one. They're hoping to get a better deal, or perhaps this move aligns with their future financial strategy. This part details the behind the scenes players. You see the big investment banks like Barclays, Citigroup, and others involved in this deal. They act as the middlemen, buying the notes from Sempra and then selling them to investors in the public market. The fact that they sold these notes at 100% of their face value means there was strong demand and they got exactly what they were asking for, no discount. Let's talk about the interest payments. The clock starts ticking on August 29, 2025. Sempra will pay interest twice a year, April 1st and October 1st. So the very first payment will be on April 1st of next year, 2026, and the final repayment of the principal amount is due on April 1st, 2056. That's a 31-year commitment. It's a long time in the world of finance. Here's where the fixed-to-fixed reset rate comes into play. For the first 5 years until April 2031, the interest rate is a solid 6.375%. After April 2031, though, things get a bit more dynamic. The interest rate will be tied to a benchmark rate, the 5-year US Treasury yields, which are generally considered a safe investment. However, they've put in a floor so the interest rate won't ever drop below that initial 6.375%. After April 2031, the interest rate will defer to US Treasury yields, which are generally considered a safe investment. However, they've put in a floor so the interest rate won't ever drop below that initial 6.375%. EFTA offers Sempra some certainty while still allowing for potential cost savings if interest rates generally fall. This is a super important feature for a junior subordinated note. It gives Sempra the option to skip interest payments if they feel you're in a tough spot. They can actually defer interest for up to 10 years worth of payments, maybe even longer, as long as they don't miss the final repayment date and follow certain rules. They can essentially bank up all those missed payments and pay them later. This adds another layer of risk for investors, but it gives Sempra flexibility to manage its cash flow during challenging times. Sempra also has the right to buy back these notes before the final maturity date. They can do this in whole or in part starting 90 days before April 1st, 2031, and then on any interest payment date after that. The price they'll pay is the face value of the notes plus any interest that's owed up to that redemption date. This is a common feature that lets companies refinance again if they find even better borrowing terms later on. Now, this is where they say, hey, what we just told you is just a summary, go read the really long legal documents for all the nitty-gritty details. The officer's certificate and the indenture are those detailed legal contracts that spell out every single condition. It's like saying, this is the trailer, the movie has way more stuff, you need to sign up for the fine print. And here you see the mention of Latham Watkins LLP. This is their legal team who provided an opinion on the legality of issuing these notes, which is standard practice for such a big financial transaction. It's like saying, our lawyers checked this out and it's all good. This section lists the exhibits, which are basically supporting documents. The underwriting agreement is the contract with the banks that helped sell the debt. The officer's certificate is the detailed description of the notes, terms, and the form of those notes. The legal opinion and consent are also included. So, looking at the big picture here, Sempra is making a strategic move to manage its debt and likely its cost of capital. They are issuing long-dated junior subordinated debt at a significant interest rate, but they're using it to pay off other obligations. This suggests they believe they can manage fits into their long-term financial plan. For investors, this offers a potentially higher yield than traditional debt, but with the risk that comes with junior subordinated status and the possibility of deferred interest payments. What does this tell us about Sempra's direction? Well, they are actively managing their balance sheet. They are raising capital for what seems like strategic purposes, probably related to their infrastructure projects or other long-term investments, given their business as a utility and energy infrastructure company. On one hand, taking on $800 million in new debt is a substantial obligation. The interest payments, especially with the potential to reset higher, could impact their earnings if interest rates rise significantly. However, the flexibility to defer payments is a significant advantage in an unpredictable economy, allowing them to weather potential downturns without immediate default on interest. The key risk here for Sempra is interest rate fluctuations. If US Treasury rates surge after 2031, their interest expense on these notes could become substantially higher than the initial 6.375%. For investors, the risk is the priority of repayment if Sempra ever face severe financial distress. These notes would be paid after more senior debt holders. Overall, Sempra appears to be navigating its financial landscape with calculated moves. This debt issuance is a tool to optimize its capital structure and fund its business objectives, while the long-term commitment represents a significant financial undertaking. The company has built in certain flexibilities. It shows they are confident in their ability to generate sufficient cash flow to cover these obligations, and likely to even refinance these notes again in the future if beneficial. Alright, that's our breakdown of Sempra's latest filing. What's your take on these numbers and what they signal for the company's future? Are they making smart financial plays or taking on too much risk? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finance. Don't forget to join our Discord community, linked in the description for more exclusive content and discussions. Thanks for watching. See you next time.